Identify and explain the different types of business enterprises. A sole proprietorship is a business owned by one individual who usually also manages the operations. The owner receives all profits but also bears all losses and is personally responsible for the business's debts. This form is simple to create and commonly used for small businesses such as local shops or independent professionals. Because there is no legal separation between the owner and the business, the owner's personal assets may be used to satisfy business obligations. Sole proprietorships are easy to operate but have limited access to capital and may face higher financial risk compared with other forms of business organization. A partnership is a business owned by two or more individuals who agree to share profits and losses. The relationship between partners is governed by a partnership agreement, which specifies how responsibilities, income, and liabilities are divided. In a general partnership, each partner may be responsible for the debts of the business, which increases risk but allows for shared management and resources. Partnerships are common in professional services such as law firms and accounting firms. They allow owners to combine skills and capital, but disagreements between partners and shared liability can create challenges in managing the business. Corporation is a separate legal entity owned by shareholders. Because the corporation is legally distinct from its owners, shareholders have limited liability and are not personally responsible for corporate debts. Corporations can raise capital by issuing stock, which makes them suitable for larger businesses. Corporations may be private or public. Private companies have shares that are not traded publicly, while public companies sell shares on stock markets, allowing many investors to participate. The corporate form provides strong access to financing and continuity of existence, but it is subject to more regulation and reporting requirements than other forms. Other types of business enterprises include joint ventures and non-profit organizations. A joint venture is formed when two or more parties combine resources to accomplish a specific business purpose, often for a limited project, and share profits and losses. Non-profit organizations are created to provide public or social benefits rather than to earn profits for owners. Examples include charities, schools, and volunteer organizations. Although non-profits may generate revenue, the funds are used to support their mission instead of being distributed to owners. Understanding these different forms of business entities is important because each has different legal, financial, and reporting requirements. Demonstrate an understanding of the accounting equation, assets equals liabilities plus equity. The accounting equation is the foundation of the accounting system and expresses the relationship between a company's resources and the claims on those resources. Assets represent economic resources owned or controlled by the business, liabilities represent obligations owed to creditors, and equity represents the owner's residual interest after liabilities are deducted from assets. The equation must always remain in balance because every transaction affects at least two accounts. This balance ensures that the financial position of the entity is properly reflected at any point in time and forms the basis for preparing the balance sheet. Every business transaction is recorded based on its effect on the accounting equation. When a transaction occurs, at least two elements of the equation change, but the equality must remain intact. For example, borrowing cash increases both assets, cash, and liabilities, loan payable, while paying a debt decreases both assets and liabilities. This rule ensures accuracy in financial records and supports the double-entry accounting system, in which every debit has a corresponding credit. Maintaining the balance of the equation after each transaction is essential for reliable financial reporting. The accounting equation also explains the structure of the balance sheet. Assets are shown on one side, while liabilities and equity together represent how those assets are financed. Creditors provide financing through liabilities, and owners provide financing through equity. This relationship helps users evaluate liquidity, solvency, and financial flexibility. By analyzing the equation, users can understand how much of the business is financed by debt versus owner investment, which is important when assessing risk and long-term stability. The equation therefore connects daily transactions to financial statements. The double-entry bookkeeping system ensures that the accounting equation stays balanced. Each transaction is recorded using debits and credits, where debits are entered on the left side of an account and credits on the right side. Increases in assets are recorded as debits, while increases in liabilities and equity are recorded as credits. Because each entry has both a debit and a credit, total debits always equal total credits. This system allows the ledger to remain balanced and provides a built-in check on accuracy, which is essential for preparing reliable financial statements and maintaining proper financial control.